Have you ever wondered how a handful of contrarian investors saw the biggest financial collapse in modern history coming while everyone else was completely blind to it? Today, we're diving deep into Michael Lewis's explosive masterpiece, The Big Short, a book that exposes the shocking truth behind the 2008 financial crisis and the brilliant misfits who profited from predicting disaster. This isn't just another boring finance book filled with jargon and statistics. The Big Short reads like a thriller, following real people who risked everything to bet against the seemingly unstoppable housing market. These weren't Wall Street insiders or privileged elites. They were outsiders, skeptics and contrarians who saw through the lies that nearly brought down the global economy. What makes this story absolutely gripping is how Lewis transforms complex financial instruments into a narrative that feels like watching a slow-motion car crash. You'll meet characters like Michael Burry, a one-eyed neurologist turned hedge fund manager who spent months buried in mortgage data, and Steve Eisman, a fund manager whose cynicism about human nature led him to discover the fraud hiding in plain sight. The book reveals how credit default swaps, collateralized debt obligations, and subprime mortgages created a house of cards that was destined to collapse. But more importantly, it shows how institutional greed, regulatory failure, and willful ignorance created the perfect storm for economic disaster. Through meticulous research and compelling storytelling, Lewis exposes not just what happened, but why it was allowed to happen. The Big Short is essential reading for anyone who wants to understand how financial markets really work and how ordinary people can protect themselves from future economic catastrophes. The Big Short chronicles the build-up to the 2008 financial crisis through the eyes of several investors who recognized the impending collapse of the housing market and positioned themselves to profit from it. Lewis focuses on four main groups of protagonists who independently discovered the same terrifying truth about the American economy. The narrative centres around the creation and explosion of the subprime mortgage market, where banks began lending money to borrowers with poor credit histories for homes they couldn't afford. These risky loans were then packaged into complex securities called collateralized debt obligations and sold to investors worldwide, creating a global network of financial exposure. Michael Burry, managing Sign Capital, becomes the first to recognise the instability of the housing market around 2005. Despite having no formal training in finance, his obsessive analysis of mortgage data reveals systematic fraud and unsustainable lending practices. He creates a new financial instrument called credit default swaps to bet against mortgage bonds. Steve Eisman, working at Front Point Partners, discovers the corruption through his investigation of subprime lenders. His team uncovers how mortgage originators were incentivized to create as many loans as possible, regardless of borrower qualification, while rating agencies were paid to give toxic securities AAA ratings. The book also follows Greg Lippmann, a Deutsche Bank trader who becomes an unlikely evangelist for betting against the housing market, and the young entrepreneurs at Cornwall Capital who stumble upon the same opportunity through different means. As the crisis unfolds, these characters face enormous pressure from colleagues, investors, and the financial establishment who believe they're insane for betting against what appears to be an unstoppable bull market. The tension builds as they watch their investments lose money for months before the inevitable collapse finally vindicates their analysis. Michael Burry's discovery represents the first major event in the Big Short's timeline. Working alone in his Sign Capital office, Burry spent countless hours analysing individual mortgage bonds, something almost no one else on Wall Street was doing. His medical training taught him to look for patterns and anomalies that others missed. When he examined the actual loans underlying these securities, he discovered that many borrowers had lied about their income, banks had stopped verifying information, and the loans were structured to fail when interest rates reset. This led him to approach Goldman Sachs and other investment banks to create credit default swaps, essentially insurance policies that would pay off if mortgage bonds failed. His persistence in the face of widespread skepticism demonstrates how breakthrough insights often come from outsiders willing to challenge conventional wisdom. Steve Eisman's investigation into subprime lenders reveals the second crucial development. Unlike Burry's data-driven approach, Eisman discovered the crisis through direct observation of the industry's practices. He visited mortgage conferences, met with lending executives, and interviewed borrowers. What he found was a system designed to exploit vulnerable people while enriching everyone involved in the loan origination process. Eisman learned that mortgage brokers were paid more for steering borrowers into high-interest subprime loans, even when they qualified for prime rates. Companies like Household Finance were specifically targeting minority and elderly borrowers with predatory practices. This human element of the crisis shows how financial innovation can become a tool for systematic exploitation when proper oversight is absent. The role of rating agencies emerges as the third critical factor enabling the crisis. Moody's, Standard & Poor's and Fitch were supposed to evaluate the risk of mortgage securities, but their business model created fatal conflicts of interest. These agencies were paid by the same investment banks whose products they were rating, creating enormous pressure to give favourable ratings. Lewis reveals how rating agencies would work with banks to structure deals that would receive AAA ratings regardless of the underlying loan quality. Internal emails and documents show that rating agency employees knew they were rating junk bonds as safe investments, but competitive pressures prevented them from acting responsibly. This regulatory capture demonstrates how supposedly independent institutions can become corrupted when their incentives are misaligned. The fourth major event involves the creation of synthetic collateralized debt obligations, which amplified the crisis beyond anything the original mortgage market could have produced. These instruments were bets on other mortgage securities rather than actual mortgages, meaning the total exposure to housing risk became many times larger than the underlying mortgage market itself. Investment banks like Goldman Sachs were creating synthetic CDOs specifically designed to fail, then selling them to unsuspecting investors while simultaneously betting against them. This practice turned the financial system into a massive casino where the house was rigged against ordinary investors and pension funds. Greg Lippmann's evangelical mission to spread awareness about the housing bubble represents the fifth significant development. As a Deutsche Bank trader, Lippmann had access to proprietary information about mortgage markets that convinced him the system was unsustainable. Rather than quietly profiting from this knowledge, he actively sought out investors to buy credit default swaps, essentially building a coalition of people betting against the housing market. His presentations to hedge funds and institutional investors reveal how difficult it was to convince smart people that something so universally accepted could be fundamentally wrong. Lippmann's efforts show how financial markets can remain irrational longer than individual investors can remain solvent. The sixth crucial event is the regulatory and political response to early warning signs. When housing prices began declining in certain markets, rather than acknowledging the problem, politicians and regulators doubled down on policies that encouraged more lending. Federal Reserve Chairman Alan Greenspan dismissed concerns about housing bubbles, while government-sponsored enterprises like Fannie Mae and Freddie Mac continued expanding their involvement in subprime lending. This institutional denial demonstrates how cognitive biases and political pressures can prevent appropriate responses to emerging crises. The final major event is the actual collapse and its aftermath. When the housing market finally crashed, the financial system proved even more fragile than the protagonists had predicted. Major investment banks like Lehman Brothers collapsed while others required government bailouts to survive. The crisis spread globally, affecting countries that had purchased American mortgage securities. Most shocking was the revelation that many of the institutions that had created the crisis were deemed too big to fail, leading to taxpayer-funded rescues while the architects of the disaster faced few consequences. The Big Short offers profound lessons about recognizing and navigating financial markets. The first key takeaway is the importance of independent thinking and contrarian analysis. Every protagonist in the book succeeded by questioning assumptions that everyone else accepted without examination. Michael Burry's success came from doing research that others found too tedious or unnecessary. This teaches us that extraordinary returns often come from extraordinary effort and willingness to challenge consensus views. In our own financial lives, this means conducting thorough research before making investment decisions and being skeptical of popular trends or get-rich-quick schemes. Understanding incentive structures represents the second crucial lesson. The crisis occurred because individuals and institutions were rewarded for behaviour that created systemic risk. Mortgage brokers earned more by steering borrowers into inappropriate loans, rating agencies were paid by the companies whose products they rated, and bank executives received bonuses based on short-term profits, regardless of long-term consequences. This teaches us to always ask who benefits from any financial product or advice we receive. When evaluating investment opportunities, we should consider whether the people selling them have aligned interest with our own success. The third takeaway involves recognizing the difference between complexity and sophistication. The mortgage securities that caused the crisis were incredibly complex, but this complexity often masked fundamental flaws rather than indicating superior financial engineering. Many investors assumed that complicated products from prestigious institutions must be safe and profitable. The lesson is that complexity can be used to hide risk rather than manage it. Simple, transparent investments are often superior to complex products that are difficult to understand and evaluate. Risk management emerges as the fourth essential lesson. The protagonists succeeded not just because they identified the problem, but because they managed their positions carefully while waiting for the market to recognise reality. Michael Burry faced enormous pressure from investors who wanted to withdraw their money as his credit default swaps lost value before the crisis hit. This teaches us that being right about markets isn't enough. We also need sufficient capital and patience to withstand periods when our analysis hasn't yet been validated by market prices. The fifth key insight concerns the importance of regulatory oversight and the dangers of regulatory capture. The crisis occurred partly because regulators either failed to understand the risks or were too close to the industries they were supposed to monitor. This teaches us that investor protection requires constant vigilance and that we cannot rely solely on regulators to prevent financial fraud or excessive risk-taking. Individual investors must take responsibility for understanding the risk in their own portfolios and the broader financial system. Understanding market psychology represents the sixth crucial lesson. The housing bubble persisted not because the underlying economics made sense, but because collective belief in rising prices created self-reinforcing behaviour. This demonstrates how markets can remain disconnected from fundamental value for extended periods, especially when participants have strong emotional or financial reasons to maintain their beliefs. The lesson is that successful investing requires understanding both analytical fundamentals and human psychology. The seventh takeaway involves the importance of diversification and avoiding concentration risk. While the protagonists profited from betting against mortgages, they took enormous risks by concentrating their investments in a single thing. Most investors should learn the opposite lesson: the importance of diversification across different asset classes, geographic regions, and time periods. The crisis showed how seemingly unrelated investments can become correlated during periods of market stress. The eighth lesson concerns the role of leverage in amplifying both gains and losses. The financial institutions that collapsed during the crisis had borrowed heavily to increase their returns, but this leverage also magnified their losses when markets turned against them. This teaches individual investors to be extremely cautious about borrowing money to invest, and to understand how leverage can destroy wealth as quickly as it creates it. The ninth insight involves the importance of understanding counterparty risk. Many investors who thought they were protected by insurance or hedging strategies discovered that their protection was worthless when the institutions providing it became insolvent. This teaches us to consider not just whether our investments are good, but whether the institutions holding them are financially sound and properly regulated. The final takeaway is about the persistence required for successful contrarian investing. Every protagonist in the book faced periods of doubt, criticism, and financial pressure while waiting for their analysis to be vindicated. This teaches us that successful investing often requires the ability to withstand social pressure and maintain conviction in our analysis even when markets move against us temporarily. The Big Short stands as more than just a chronicle of financial disaster. It serves as an essential guide for understanding how markets really work and how ordinary people can protect themselves from future crises. Michael Lewis has created a masterpiece that transforms complex financial concepts into a gripping narrative that reads like a thriller while delivering profound insights about human nature, institutional failure, and the price of willful ignorance. The book's greatest strength lies in its ability to make the abstract concrete through compelling characters and vivid storytelling. By following real people who risk everything to bet against conventional wisdom, Lewis shows us that financial markets are not efficient machines, but human institutions subject to the same biases, incentives, and failures that affect all human endeavours. This humanisation of finance makes the book accessible to general readers while providing sophisticated insights for professional investors. Perhaps most importantly, The Big Short demonstrates that individuals can successfully navigate complex financial systems by developing critical thinking skills, understanding incentive structures, and maintaining independence from crowd psychology. The protagonists succeeded not because they had superior access to information or special connections, but because they were willing to do the work necessary to understand reality and act on their convictions despite social pressure. The book also serves as a warning about the dangers of allowing financial institutions to become too large and interconnected to fail. The crisis occurred not just because of individual bad decisions, but because of systemic problems that made disaster inevitable. This teaches us that individual financial success must be balanced with awareness of broader economic risks and the importance of supporting appropriate regulation and oversight. For anyone seeking to understand money markets and economic systems, The Big Short provides an invaluable foundation. It shows us that financial literacy is not just about understanding investment products, but about developing the critical thinking skills necessary to see through institutional propaganda and protect ourselves from sophisticated forms of exploitation. The book's lessons remain highly relevant today as new forms of financial innovation continue to create both opportunities and risks for investors and society as a whole.